So it is my distinct privilege to introduce to you the president who will give the inaugural, the address today, Robert Stambaugh. When 3 years ago I was asked to run against Stambaugh, I said, really, I don't want to do that. Not only because I would lose, as I did, but also because not even I wanted to vote for myself. Rob is really sort of a ideal president in every dimension you can imagine, and is a very hard act to follow. First of all, he is an ideal president for his outstanding research achievement. He has been sort of in the last 30, almost 40 years, he has been sort of at the forefront of all the research that took place in investment asset pricing in very many dimensions. Starting with his dissertation that was already a big hit on how to address the famous Roll critique on the unobservability of the market portfolio. Then he was basically at ground zero on the stock return predictability literature that now is sort of ballooned into an enormous literature, but he was one of the first, starting with his 1986 paper with Keim, where he sort of see the predictability issue as not just about stock, but stock and bond contemporaneously. He has sort of a very interesting paper in 96 with Kendall looking at what does it mean predictability for portfolio allocation choices, which is extremely important. And he also has his own bias. There is the Stambaugh bias, as it's known in the literature, is linked to a predictive regression when you regress return on a variable, and then this variable is autocorrelated, and the errors of the two regressions are potentially correlated as they are in the case, you end up underestimating the effect, and this is known in the literature as Stambaugh bias. And his actually most cited paper is related to this, but also related to another literature that has ballooned since, which is sort of the literature on volatility and the link between volatility and predictability. This is his 1987 paper with French and Short. Now, being a Chicago student, he also wrote some papers on consumption-based capital asset pricing model, which some of my colleagues are very excited about. But I will skip those in favor of sort of what I consider his most long-lasting contribution, which is has to do with liquidity. I think that this is a paper written with my colleague Lupus Pasteur, and it's a very simple idea, but extremely powerful. You know, we need to measure things in order to establish their importance, and liquidity, as Maureen O'Hara said, is like pornography. You sort of only see after the fact. It's very hard to define, very even more difficult to measure. And their idea is a very simple idea. I think that all the great ideas are very simple. This was a very simple idea saying that liquidity is lower when you see a greater tendency of order flow in a different direction on a day to be followed by a price change in the opposite direction the next day. So if you think that the market is illiquid, when there is a lot of volume, then prices move a lot, and so they tend to move back. There is a bit of mean reversion next day. That's a measure of liquidity that they identify, and surprisingly enough, this measure has a quite large impact, or at least the beta of this measure is a very large impact on asset pricing. Rob is also known for a lot of Bayesian analysis, and most recently he has sort of been in the news for a paper he has written with Lubo Pasteur on sort of turning around the conventional wisdom that stock returns are less volatile in the long term. So as an investor, you're better off with stock because there is some mean reversion, the volatility will be lower in the long term. And say they established that no, if you take into consideration the parameter risk, this effect is not there, and the stocks might be more dangerous. Now, Interestingly, this paper has been published in 2012. In 2012, Rob has 3 papers published, one in the JFE, one in the JF, and one in the JPE. This is a record that most young assistant professor would be very envious of, and he has done that basically last year, and that's quite impressive. But being an outstanding scholar is only one part of what Rob is about. The second part is also an outstanding member of the profession. He has been an associate editor of all the 3 major journals and has been, of course, a editor of the JF and a great editor of our association journal. Finally, Rob is also an outstanding human being. He's a very reserved person, and it took me quite a while to find out information, because most people said, oh, yes, I was a colleague of him, I am a colleague of him, but there is nothing I can report except that he's a very nice person. So I think it was a very hard to find out who really Rob Stambaugh is. And what I discovered is that he's an acquired taste. People don't immediately sort of warm up to him, but once they know him, they love him. And so the interesting thing is that he has been married for almost 40 years with Kathy. Apparently, this is what I was told, when he invited Kathy for his first date, their first date, she thought he was somebody else. And so she accepted to go on a date thinking that Rob was somebody else. And but loved the date so much that went to the second date, and she has been married for the last 40 years. So really, to know him is to love him. He's also very quiet and never sort of loses temper. Apparently, in a day like yesterday in Philadelphia, his car got rear bumped by somebody. So generally, it's not a pleasant experience. You get out and you get angry or sort of start shouting. Not only he didn't do that, but first of all, he found out that who bumped him was a student, a former student, and the former student got invited to give a lecture in class. So I don't know whether this is a penalty that he imposed, but I think that shows how sort of gracious he is in every situation. And I have sort of my little experience of this graciousness when I was on the job market and I visited Wharton. One of my papers that was sent in the old version, and there was a mistake. And now in the job market, you don't want to have a mistake in the paper. But if you do, you want to find a person like Rob Stambaugh who tells you very politely during a meeting rather than shouting in the seminar. So I think that for all this reason, I really ask you to welcome the current president of the American Finance Association, Robert Stambaugh.
Well, thank you so much, Luigi, for that very kind introduction. At a career milestone like this, I suppose one tends to reflect a bit on history. I've been teaching investments to business school students since about 1980. One of the issues always central to the tension between the academic subject and real-world practice is the divide between active investment management and passive management or indexing. Of course, the latter is probably what much of your teaching and mine has pointed to as the sensible choice, and those of us sort of long engaged in the educational mission are perhaps heartened by at least some trends in investment management over the decades. For example, here are a time series of the market share of active management. The thicker line on top plots the fraction of equity mutual fund assets that are actively managed. In 1980, that fraction was nearly 100%, whereas it had drifted down to 83% by 2012. The thinner line underneath plots the share of institutionally owned equity under active management, which went from 81% in 1985 to 59% in 2006. The latter series I took from Ken French's 2008 presidential address. Market share is not the only thing about active management that drifted downward. Here's a plot of overall fee rates. While institutional fees stayed fairly flat at around 40 basis points, again based on Ken's data. The thicker line on top shows that fees for mutual funds fell from about 2.3% to about 1% in 2012, largely due to reductions in amortized load charges. This is a series constructed by the Investment Company Institute. Next, I've plotted the tracking error of the aggregate portfolio of actively managed mutual funds using a comprehensive data set of active funds constructed for a recent paper I have with Lou Bush-Pastor and Luke Taylor. The value plotted for a given year is the annualized standard deviation of the market-adjusted return for the subsequent 5 years. Here again, there's an evident downward trend with tracking error falling from over 2% in 1980 to a little over 1% in 2006. So in essence, not only did active management lose market share and charge lower fees, but it also became more index-like as an investment. Moreover, this tendency to become more index-like shows up not just in tracking error, but also in the holdings of active managers. Here's a plot of what Kramers and Petagisto define as active share, computed for the aggregate portfolio of active mutual funds. It reflects the sum across all stocks of the deviation between the active weight on a stock and the stock's index weighting. This series is computed with respect to the Russell 1000 benchmark, and I'm grateful to Martin Kramers for sending this to me. Here we see a significant downward trend in this series as well, with active share falling from 38% in 1980 to 23% in 2011. So these series I've shown you point to an overall sort of shrinking footprint for active management over the past few decades. Not only has its market share dropped and its fee rates declined, but its overall investment portfolio has become more index-like. So many of us may take heart from these trends and believe that they represent at least a partial victory for education, as well as a rational response to the negative historical track record of active management overall. I certainly don't want to dissuade you from such a view, but I want to suggest that there could be an underlying economic factor at work in contributing to these investment trends. This is a plot of the fraction of the U.S. equity market that is owned directly by individuals. Since 1980, that fraction has fallen by more than half, from 48% to around 20%. This drop actually continues a trend that began really after World War II, when households directly held more than 90% of U.S. equity. Explanatory factors likely include government tax and retirement policies, as concluded by Reidquist, Spitzman, and Strebuliaev in an article just out in JFE. I show you this plot because my hypothesis here this evening is that this decline in direct individual ownership coincides with a decline in the presence of what we often call noise traders, and a decline in noise trading then dictates a smaller footprint for active management. So why interpret this plot as a decline in noise trading? The late Fisher Black, in his 1986 presidential address, described noise traders as people who trade, even though from an objective point of view they would be better off not trading. The behavioral finance literature presents empirical evidence pointing to numerous factors that lead individuals to make unproductive investment decisions when trading stocks directly. Like the series I plotted here is just an updated version of the one Ken French constructed in his 2008 address. And he too suggests that the pool of investors most likely to make mistakes may have shrunk as a result of this downward trend. We know that active management, if it's to profit, must do so at the expense of others, and noise traders are the obvious candidates to be the losers. My hypothesis that fewer noise traders leads to less active management seems intuitively simple, but the question is whether such an effect can play an economically significant role in interpreting the investment trends I showed you. So to answer that question, I really need an equilibrium model. Not surprisingly, my favorite model for this purpose is the one I develop here. The model has four types of agents. Noise traders own fraction H of the stock market. They buy individual stocks directly. Investors own fraction 1 minus H of the stock market. They don't buy individual stocks and instead allocate their stock market investment between an index fund and active managers. Their objective in that allocation is to maximize the resulting single period Sharpe ratio, which is, of course, expected excess return divided by standard deviation. There are many investors acting competitively in that each investor assumes that his or her own investment allocations have no effect on the expected returns and volatilities of the active managers. Each active manager maximizes his information ratio, which is net alpha divided by market adjusted volatility. Net alpha reflects the manager's proportional fee rate as well as trading costs paid to intermediaries. The manager incurs trading costs when deviating from benchmark weights, and those costs are convex in the amount traded. Managers have homogeneous information and they act competitively in that when maximizing their information ratios, each takes as given stock prices as well as his or her assets under management. Intermediaries play no role in the model other than to receive the trading costs incurred by active managers. There are many stocks, each has a beta of 1, and market adjusted returns are uncorrelated across assets. I should say at this point, given I'm summarizing the model on just a few slides, I should mention two things. First, the accompanying paper is available on SSRN. It contains the notation, equations, proofs that I'm sparing you here. Second, most references in the paper, I also have to omit here mentioning in my talk. I apologize to those authors for having to do so in the interest of time. The main implications of the model rest on the presence of mispricing, and in particular, how much of it there is in equilibrium. P, the equilibrium price of a stock, equals P bar plus a pricing error. P bar is the price at which the stock has zero alpha. If all stocks' prices equal their P bars, then the market portfolio is mean variance efficient and there's cap-in pricing. The pricing error is a fraction theta of the difference between P hat and P bar. P hat is the price that would prevail if the investors were simply to allocate all of their stock market investing to an index fund. As P hat is determined solely by the demands of the noise traders. If the noise traders in aggregate want to have twice as much money invested in Tesla than in Ford, then Tesla's market cap will be twice Ford's if there's no active management. And that's true independent of how much money the noise traders have. When there is active management, most of the difference between P hat and P bar does not flow through to the equilibrium price. The fraction theta that does flow through depends on several quantities. It's the same for all stocks. First, it's increasing in H, the fraction of the stock market owned by noise traders. So here their money does matter. The less they have, the less their demands impact the equilibrium price. Theta is also increasing in both trading costs and idiosyncratic volatility, which is consistent with empirical evidence that mispricing is lower, both when liquidity is high and when idiosyncratic volatility is low. If trading costs approach zero and the number of stocks grows large so that idiosyncratic volatility can be diversified away, then a Steve Ross style arbitrage argument would have the equilibrium prices approach the P bars, and just a vanishingly small amount of active management would deliver that. But in general, such arbitrage is impeded by trading costs, along with the number of stocks being finite, and thus in general, equilibrium prices contain a positive fraction theta of the mispricing induced by noise traders. And that mispricing supports an active management industry. The amount of mispricing aggregated across stocks determines how big a footprint active management has. The information ratio of active management is increasing in the amount of mispricing. Active managers also receive more fee revenue as a result, but the amount of money they manage depends on the fee rate. What's uniquely determined is the product of the fee rate and the fraction investors allocate to active management. Active managers, both individually and in aggregate, face unit elasticity with respect to their fee rates. Charging a higher fee rate simply means that they get proportionally less money to manage, leaving the fee revenue unaffected. At the aggregate level, the fee rate here technically refers to the harmonic mean of fee rates across managers. A couple of other implications of the model I'll just mention briefly. both the net alpha and the tracking error of the aggregate active portfolio are proportional to the fee rate, and thus the information ratio is unaffected by that fee rate. Also, active management's trading costs as a fraction of the assets under management equal the fee rate. In fact, there's empirical evidence to support that implication in a recent article by Evans, Edlin, and Cadlick. Now, the amount of mispricing that exists in equilibrium depends on both theta and p hat. Theta is generally going to be small. It's less than 0.001 in the calibrations I'll show you coming up. The issue is then p hat, which is determined by the demands of the noise traders. The simplest way to think about noise trader demands is first just to normalize each stock's price by the expectation of its next period value. Those are the expectations that active managers use. Then the difference between p hat and p bar is by definition given by the relation shown here. PM is the average share price, or the price of a share in the market, and phi is stock I's weight in the aggregate noise trader portfolio. Now, under this normalization, the existence of mispricing then simply depends on the extent to which noise trader weights differ from equal weights across stocks. Now, we know that portfolios of stock held directly by individuals are notoriously undiversified, as we've known for nearly 4 decades. A more recent 2005 study by Pokovnichenko finds that among households with liquid financial assets in excess of $1 million, those that hold stocks directly typically hold 15 or less, even when a substantial fraction of their financial wealth is in diversified mutual funds. In the remaining income cohorts, households that directly own stocks typically hold 3 or less. There's also significant evidence of empirical evidence of commonality in the stock holdings across individuals. For example, Barber and Odeen document attention effects that induce individual investors to focus on stocks that have appeared in news stories or have experienced extreme returns or trading volume. Fong and Perez find that stocks with high media coverage earn low returns, especially stocks with relatively high individual ownership. So in general, empirical evidence suggests that the individual investors respond to various events and stimuli in common ways. Due to behavioral biases and constraints on their ability to obtain and process information, not readily available. The key issue with regard to pricing effects is the degree to which the low diversification, typical of direct stock holdings by individuals, survives aggregation across individuals. The behavioral evidence suggests that some of the low diversification will survive aggregation, but the precise amount is not really pinned down. In calibrating the model, I allow a wide range for the shape of the distribution of aggregate noise trader demands across stocks. This figure shows examples of the distribution across stocks of n times the weight on each stock, where n is the number of stocks in the market. These distributions are all approximated by a continuous variable density, given that n is large. Density in this case is determined by a single positive parameter, k, that determines the shape. The mean of each density must always equal 1 because the weights across stocks must sum to 1. As k becomes large, say 20, as shown by the magenta curve, the density concentrates more around 1, corresponding to a setting in which low diversification typical of individual holdings essentially washes out in aggregation. As k becomes small, say 0.2, as shown by the dark blue curve, the density gets a lot of mass near 0 and becomes very skewed, corresponding to a setting in which low diversification flows through non-trivially to the aggregate noise trader portfolio. That is, many stocks are underweighted, but a relative few receive large weights. So with this short overview of the model in hand, let me now return to the trends in the data that I displayed earlier. First, my objective is not to try to explain year-to-year fluctuations, but instead to focus on trends. So the data I take to the model will consist of simple linear trends fit through the actual series. So in all that follows, the black lines will represent the actual data, and the green lines will represent trends fitted through the data. This figure displays the declining trend for the fraction of equity owned directly by individuals seen earlier, and this one displays the various trends for active management that I showed earlier. You will notice that in each of the two upper plots, the fraction allocated to active management, and the fee rate, I fit a single trend line that averages trends through the individual series for mutual funds and institutions. From the model's perspective, an inconvenient feature of the real world is that investors served by professional money management are really essentially split into two segments: retail mutual fund investors and institutional investors such as pension funds. So extending the model to admit such segmentation could be worthwhile, but for now I make a compromise. My objective of averaging the trends across the retail and institutional segments is to have the data discipline the single resulting trend in a way that, while rudimentary, is representative of changes in investment management within each segment. An alternative would be to ignore the segmentation and simply combine the two segments into one pool, weighting by the respective sizes of each segment. I think this approach seems less desirable in the context of investors' allocations decisions being modeled here. Although many retail investors have an indirect stake in institutional portfolios through their pensions and so forth, they generally can't directly access the lower fee institutional active management when allocating between active and passive management. And by the same token, institutions making that allocation decision don't face the higher fees of the retail segment. If the segments are instead pooled, the resulting composite active fee rate actually trends upward, contrary to the experience of investors in either segment. The reason for the upward trend is the growth of mutual funds that accompanied the migration from direct individual ownership. In fact, Ken French observed in his address that this growth in the retail segment share of the investment management industry was a major factor in keeping society's overall cost of active investing relatively constant over the decades, despite reductions in trading costs and mutual fund load fees. Okay, so in calibrating the model, a number of the parameters have very straightforward empirical counterparts that I take from the data. Essentially, two parameters need to be determined. One is this liquidity or trading cost parameter, and the other is K, which governs the shape of the distribution of the noise trader weights across stocks. What I do is calibrate these to the mid-sample 1996 points from the data trends. So the resulting value of the liquidity parameter translates to a proportional trading cost that is roughly equal to the fraction of the stock's market cap. In other words, establishing an active position that is 50 basis points of a stock's market cap costs about 50 basis points of the position. The calibrated value of K is about 0.2, corresponding to a density I mentioned earlier, in which the low diversification typical of individuals' holdings survives aggregation to a significant degree. Okay, so given those parameters, I then compute the model's implied values for the other 32 years in the sample period. Okay. I start with the aggregate active portfolio's tracking error. I condition on the data trend values for the active allocation, fee rate, and noise trader fraction, and then compute the model's implied tracking error. I might note the parameter K doesn't enter these calculations of the implied tracking error. So the result is the red line. And all that follows, I'll use red to plot model implied values. Recall that black represents data and green represents the data trends. So the red and green lines cross in the middle by construction. But note that the model produces a negative trend in tracking error, and one only slightly less steep than the data trend. The data trend declines from about 2% to 1%, whereas the model trend declines from 1.8% to 1.2%. And next turn to the fraction that investors allocate to active management. Recall that the model does not determine the fee rate and the active allocation separately, only their product matters. So I therefore condition on the fee rate as well as the noise trader fraction and plot the model's implied allocation to active management. As before, the red and green lines cross in the middle by construction, but observe that, again, the model implies a downward trend in the active allocation. As you can see, this time the model works a bit too well in that regard, implying a somewhat sharper decline in active management's market share than what the data exhibit. I also think this isn't too bad for such a simple model of essentially just two free parameters. If we think about tweaking the calibration, you might ask whether the distribution of noise trader weights should remain the same as the noise trader fraction declines. A more reasonable assumption might be that low diversification survives aggregation across noise traders a bit better when there are fewer noise traders. This would keep mispricing from falling as fast as when the noise trader fraction declines, and therefore the active allocation would not fall as fast. So I instead let the parameter k decline linearly with noise trader fraction to see if I can better align the model and data trends in active allocations. And as you can see, doing so allows close agreement between the data and model trends. But the decline in k required to accomplish this appears to be pretty modest. Here I've plotted the implied noise trader densities for 1980 and 2012. The two k values are 0.228, 0.201. The 2012 density is farther to the left, corresponding to a sort of more undiversified aggregate portfolio of the noise traders, but the shift doesn't seem very big. So when turning to the model's implications for the aggregate active share, which had to do with the weights in the portfolio, I held my breath a little because the active share is not used at all in any of the calibration, and even in nailing down the mid-sample value. So I was prepared for it to be sort of orders of magnitude off. Turns out it's not, and moreover, it slopes downward at a rate not so different from the data. As for magnitudes, the model's active share is about twice as large as the data's, but it's still less than the average fund active share that Kramers and Petagisto report along with the aggregate value. So to summarize the calibration exercise I just presented, it does seem reasonable at least to entertain the notion that the trends we've seen in past decades in active management can be linked to the decline in individual equity ownership, with the latter interpreted as a decline in noise trading. So many of you by now might be thinking, but wait, one glaring counterfactual is that the model implies a positive alpha for active management. It's true, of course, that the model assumes investors correctly perceive a positive net alpha on active management. That alpha is earned at the expense of the noise traders. For example, in 1980, the calibrated model implies a positive net alpha of about 4 basis points a year. Not very large seemingly, but that's precisely large enough to imply an allocation of 91% to active management when the tracking error is less than 2% and the index fund is characterized by its historical performance. That's the allocation that maximizes the overall Sharpe ratio. In contrast, for the aggregate active portfolio based on the Pastor Stambaugh Taylor data set I mentioned earlier, the post-1980 estimated net alpha is instead minus 31 basis points. Well, if investors unwittingly allocate too much to active management, then the net alpha can become negative. In that case, the fees that are paid to managers and the trading costs that are paid to intermediaries are more than can be made up by the manager's positive gross alpha, despite managers optimizing with what they've been given to manage. By the way, gross alpha is always positive for active management, negative for noise traders, and 0 for the weighted combination. In this example, the model as calibrated implies that if the correct allocation in 1980 was instead just 70%, then a 91% allocation would have driven the true net alpha to minus 31 basis points, the same as the post-1980 estimate. So active management here faces decreasing returns to scale in its industry size. The more active management is given to manage, the lower its alpha. As Luboš and I showed in our 2012 JPE article, when investors have to learn the correct allocation by observing the history of active allocations and realized returns, they can easily misallocate and converge only slowly to the correct allocation. Now, we looked at a setting with a constant true underlying relation between the allocation and alpha. When that relation changes, as it does when the noise trader fraction declines, one must suspect that misallocation only becomes more likely. It seems reasonable to entertain over-allocation to active management as the source of the negative estimated historical alpha. One might further entertain the retail segment of investors being a potential location of that over-allocation, at least compared to the institutional segment, given that the retail segment has allocated a greater fraction to active management despite being subject to higher fee rates. But it's important to note that the rational aggregate response to a negative historical track record is not to reduce the allocation to active management all the way down to zero. Prices would then be at the complete mercy of the noise traders, and positive alpha for some amount of potential active management would be left on the table. Let me now come back to the central role played by the fraction of noise traders in the market. Here I plot two implied quantities from the model as a function of that noise trader fraction H. The first, shown as the solid line, is the product of the fee rate F and the fraction investors allocate to active management Y. Again, recall that the product of F and Y is what gets uniquely determined. We see that F times Y declines as H does. So as the fraction of noise trader declines, so does this product of F and Y. The second quantity I plotted with the dashed line is that product of F and Y times 1 minus H. This quantity is active management's fee revenue as a fraction of the total value of the equity market. So when H is high, a decline in H increases fee revenue. The investors, who are the source of assets for both index funds and active management, have progressively more to invest as H declines. But as H continues to decline, the fee revenue falls as well. The decline in H brings less mispricing and dictates a smaller footprint for active management. So as the final perspective, I ask, what happens if this H continues to decline? In particular, suppose the individual ownership fraction, interpreted as the noise trader fraction H, continues its downward trend, and suppose that active management's market share continues its same downward trend. So the plot here goes out to the year 2042. That's when the noise trader extrapolation hits zero. And I want to stress, this is just a hypothetical, not a forecast. So here are the implied model values conditioned on those trends. Again, recall that the product of the fee rate and market share is what gets uniquely determined. The market share can always be increased by lowering the fee rate. The decline in the fee rate, shown here as the solid line, is simply what's required to keep active management's market share from dropping any faster than the trend it's been following. In that case, the tracking error also declines. In essence, even if active management were to maintain its current downward trend in market share, it would still have to behave increasingly like an index fund if the noise trader share continues its decline. So I'll leave you with that thought, however discouraging or encouraging it might be. And thanks for listening, and thank you especially for the privilege and honor of serving as president of this great association.
So before adjourning this session, we'd like to give to Rob two things that to remind of the association. The first is the sign that he has been president, and the second, one of the privileges of being president is you become also a fellow. So this very handy sign of your fellowship. And now the session is closed and there is a reception outside, so please join the reception.